It's easy to point fingers at the US when talking about debt. Record high deficits, political chaos, a $34 trillion federal IOU. But while America argues over borrowing limits on live TV, China's debt is quietly climbing, way faster, far deeper, and with almost no global headlines. On paper, China looks responsible. Its debt to GDP ratio? A calm 84% compared to 123% in the US. But dig just a little below the surface, and the numbers become terrifying. China is one of the most powerful economies in the world. It's the world's factory, the largest exporter, and a global player in tech, energy, and finance. But behind all that power is a hidden debt web. Local governments, state-owned companies, special investment vehicles, they're all borrowing, and no one's keeping count. Some estimates say China's real debt is over 300% of GDP. Others, as high as 450%, if you trust independent data. Either way, it's more than the US, more than Japan, more than almost any economy in modern history. And the worst part? No one knows exactly how bad it is. In the US, it's simple. The federal government borrows most of the money. States and cities add a bit more, around 12% of GDP. But in China, debt is scattered across a maze of public and semi-public entities. Provincial governments, shadow local authorities, state-owned corporations, banks. Owned by the state, each one takes on debt, technically on their own books, but ultimately backed by the same entity, the Chinese Communist Party. It's a shell game. Debt moves, faces change, but the burden grows. By 2023, local governments alone held $12.6 trillion in debt, around 76% of China's GDP. But that's just the start. State-owned enterprises, construction giants, energy firms, even banks, owe another $30 trillion combined. All in, China's real public debt load could exceed $50 trillion. That's more than 300% of GDP. And if China's GDP is overreported, as some economists believe, that ratio jumps even higher. Here's the strange part. China borrows more than almost anyone, but pays lower interest rates than most developed nations. A US 10-year bond yields around 4.5%. China's equivalent, just 1.7%. So how is that possible? Simple. Capital controls. Investors in China, banks, pension funds, regular citizens, can't easily move money abroad. So they park it in bonds, even low-yield ones, even risky ones. There's also no real stock market alternative. Over the past 20 years, Chinese stock indexes have barely moved. Compare that to the US, which has tripled in the same time. So while Americans invest in stocks, startups, or crypto, Chinese citizens buy real estate or government debt. Let's talk about that for a second. China's real estate market is the largest asset class in the world. People poured their life savings into apartments, not to live in, but as investments. In Beijing, the average home costs 35 times the average income. For reference, Louisiana is 7.5x, London is 19x. Why so high? Because there's nowhere else to put your money. And now that bubble is wobbling. Developers like Evergrande and Country Garden are defaulting. Housing prices are slipping. And consumer confidence is cracking. Here's what happens next. People stop spending. They save, hoping to afford a home or protect what they have. That leads to deflation, a rare and dangerous problem where prices fall. It sounds good, until you realize deflation makes people delay spending even more. Why buy today if it'll be cheaper tomorrow? That slows growth, kills jobs, and puts even more pressure on the government to stimulate the economy, usually by borrowing more. You've probably heard the meme, money printer go brr. In the US, the money supply tripled between 2000 and 2019. In China, it multiplied 16 times. Why no inflation? Because Chinese consumers aren't spending. They're hoarding, and the government keeps the stats looking clean. But money has to go somewhere. And in China, it went into land, housing, and public projects. Let's be fair. China has options. Unlike the US, China owns most of its debt and its lenders. It also owns massive assets, land, companies, banks, factories. By some estimates, China has a positive net worth of $40 trillion, which means, technically, it could sell off assets to pay off debt. But that's theoretical. In practice, selling off land or major companies would be politically risky and economically disruptive. The risk isn't that China's economy suddenly collapses overnight. It's that it slowly jams up. Too much debt, too little innovation. Too many government-owned companies doing unproductive work, because they're told to, not because the market wants it. The more China prints, borrows, and builds without clear demand, the harder it becomes to shift to a consumption-led economy. The US and China are locked in a strange mirror game. The US overconsumes, inflates, and leans on private markets. China underconsumes, deflates, and leans on state control. The US debt is loud. China's is quiet. Both are unsustainable, just in very different ways. If tensions escalate or if demand for Chinese goods slows, China loses its lifeline, exports, and the cracks start to show. China isn't heading toward a sudden collapse, it's heading toward a reckoning, a moment where real estate stops absorbing money exports. Slow down local governments can't roll over debt, and the silence around the crisis breaks on paper. China is a thriving machine. But beneath the surface, it's more like a house of mirrors. The question isn't whether the system will hold. The question is, how long can it hide? China's debt crisis may not be loud, but it's very real. The question isn't whether it breaks, it's when. If you found this breakdown helpful, subscribe for more documentary-style stories on the psychology of money, digital systems, and global economics. Stay curious. Stay informed. This is InnerEconomics.